Hi everyone and welcome to the third video of this week. So in the last video we have seen a number of concepts such as CAPEX, OPEX, cost-benefit analysis and the capital recovery factor. In this video we will now use these concepts to calculate the costs of mitigation of greenhouse gas emissions. We will focus on the cost per ton of avoided CO2. We will call that the specific mitigation costs. We will indicate it with letter C. And of course, it is first applied to CO2, but it can also be applied to other greenhouse gases, as we will see later. Now, first of all, the basic approach is very simple. If we implement a project that mitigates CO2 emissions, we simply calculate the specific mitigation cost as the extra cost per year divided by the avoided CO2 emissions per year. The extra costs are the cost compared to a reference situation, e.g. the situation in which you do nothing. Also, the avoided emissions is compared to the same reference situation. And if we take the concepts that we used in the previous video, we can also describe the extra cost as the CAPEX times the capital recovery factor. So that's the investment related cost plus the annual cost for operation and maintenance minus the benefits, which can be, for example, saved energy or the value of produced energy. Then we divide them by the avoided CO2 emissions per year. So this is simply the formula for calculating the cost per ton of avoided CO2. Let's go back to the solar panels example from the previous video. We fill in the formula from the previous slide with the value from the solar energy system example, listed in the grey box. 5,000 euros times a capital recovery factor of 6.4% plus 50 euros for operation and maintenance minus the benefits of 3,600 kilowatt hours times 7 cents per kilowatt hour, which is the value of electricity in the system. Note that we do not use the retail price here, but the cost that otherwise would have been made to produce the electricity. So now we have all the annual costs elements in the denominator. Next, we divide it by 3,600 kilowatt hours times an assumed emission factor of 0.4. These are the avoided emissions. The result is that the cost of avoided CO2 is 82 euros per ton. It's good to be aware that these costs can be negative, meaning that the benefits outweigh the costs. If CAPEX times CRF plus OPEX is lower in value than the benefits, then we'll have negative cost for the resulting cost of CO2 mitigation. There are various examples of technologies that show negative costs. For example, production of electricity by wind turbines is often cheaper than conventional electricity production. It will therefore lead to a negative cost of CO2 mitigation. Of course, we also need to use this formula for other greenhouse gases. The comparison is quite simple as it's just the same formula. The only difference is that you multiplied the avoided greenhouse gas emissions per year times the global warming potential of that specific greenhouse gas. And resulting costs are not in euros per ton of CO2, but in euros per ton of CO2 equivalent. The final point I want to make is that in cost-benefit analysis of greenhouse gas emissions, we often distinguish two different perspectives. One is the social cost perspective and the other is the private cost perspective. Most common is the social cost perspective. This is the perspective from society as a whole. It is the perspective in which all real costs are included. It is typically used by governments, for example, to decide whether to make certain investments. In the social cost perspective, specific taxes like energy taxes are not taken into account. In the end, taxation is neutral for society as a whole. One party pays, another party receives. Also, a so-called social discount rate is used, which is a long-term interest rate determined by many governments. The social discount rate is normally quite modest. In OECD countries, it is usually less than 5%, and in developing countries, 10% or less. Last but not least, also external costs will be taken into account. This will be discussed in the next video. In the private cost perspective, first of all, a private discount rate is used, or rather, a private rate that companies use to judge their own investments, and that can be quite high. It is often higher than 5% or even greater than 10 or 15%, depending on the sector. And they use actual prices, because for a company it makes a difference whether you have to pay a tax or not. In conclusion, there are various means of calculating specific mitigation costs.